Good evening, everyone. This is Veer Maheshwar Charitable Trust Latur MS India organizing daily international webinar series. This series is running from last 5 years, and speakers are invited from India and abroad. Every day we are joining here to listen from speakers on various topics related to education, law, finance, environment, technology, research, all these things. Today we have invited Vani K ma'am, who is assistant professor from Bangalore, Karnataka. I welcome you, ma'am, from my organization and from all the participants, those who are joined here. Being a teacher of commerce section, she have selected the topic personal financial planning and investment strategies. I welcome you, ma'am, from my organization and from all the participants. I welcome all the participants, those who are joined here. Regarding today's speaker, she is working as assistant professor, Department of Commerce and Management in Nagarjuna Degree College, Bangalore, Karnataka. She is specialized in finance and banking. She is an author of books. She presented many research papers in national and international conferences. She worked as a in editorial board for research papers also. She is awarded with outstanding research for researcher for research paper in December 2025. She is also awarded with as a faculty woman of distinction award, faculty woman of distinction award on 27th June 2026 currently. We congratulate you, ma'am, for your academic contribution and your awards you have received. And I welcome you and I request you can start your speech by unmuting yourself. Thank you.
Sir, is this audible?
Yes, ma'am, audible.
Thank you so much, sir, for this beautiful introduction. And I would really like to thank to the Veer Maheshwari Charitable Trust and Dr. BETKAR, sir, for giving me this opportunity to present and share my ideas and thoughts and also my research with all the public. So first, I would like to share my PPT. Good evening, one and all present over here. My topic is personal financial planning and investment strategies. So, financial planning is an important life skill which helps to plan for future and take better control on personal financial goals by setting realistic plans, evaluate alternatives, and take effective measures. The objective of financial planning is to ensure sufficient funds are available at the right time to achieve personal financial goals, which will help the individuals and use and protect the financial resources effectively, avoid excessive debt and improve financial security, and reduce financial uncertainty by planning for future needs. And it also enhances personal relationship through better financial decision making and communication. So, usually, financial planning, especially related to personal financial planning, it has certain process. And in today's session, we are going to see the procedure as well as the process of personal financial planning. The first thing here is to know your current financial position. The first step in the financial planning is to assess your current financial position, which involves calculating your net worth by subtracting total liabilities, which we call it as a debts, from total assets. Here, assets includes savings, property, and investments, and understanding the financial status, which will help to set realistic and achievable financial goals. So, the second step here is to develop your financial goals. After assessing your financial situation, the next step is to set SMART. So, SMART includes the words like specific, measurable, attainable, realistic, and time bound. So, goals should be included with the short term, intermediate, and long term objectives, which we are going to prioritize the needs over wants. So, needs are necessary, which cannot be avoided, and wants, which we can overcome, we can neglect it, and ensure the goals are realistic based on the current financial position and net worth. The third step here in the process, it includes identifying alternative courses of action. That is, after assessing your financial position and setting SMART goals, the next step is to identify strategies to achieve those goals. And this can be done by reallocating existing resources. Reallocating here, it means such as maybe it is related to your savings or investment, that again distributing for different investment, or generating new resources such as increasing the income or working extra hours or earning higher investment returns. We have to look for that. And the fourth step in the process, it includes evaluating alternatives. Evaluate each financial option based on your life situation, personal values, and economic conditions. Compare the advantages, disadvantages, and opportunity costs of each alternative to choose the most suitable strategy for achieving your financial goals. So, in the fifth step, we have creating and implementing the financial action plan. So before making any decision, the first thing here we need to plan whether the process is going according to our convenience or no. So in this particular step, in the fifth step of the process, financial plan outlines the actions needed to achieve your financial goals. Like, for example, choose the most suitable goals and strategies based on your current financial situation and future expectations. So, for that reason, you need to create clear, practical, and actionable steps to stay on track and successfully achieve your goals. The last step in the process is review and revise the financial plan. So here it tells about whatever the plan we have done or the strategies we have done, it is according to our convenience or no. If it is not according to our convenience, we can drop it here only. Otherwise, this is a step where we are going to review and revise the plan, whatever we have done for finance. So, here, when we talk about finance, it is completely related to money and how we are going to manage in our day to day life. The main thing in this particular topic, it is related to the strategies we are going to set for making the financial planning. So this is the last step here. It tells about regularly reviewing your financial plan, which will help to track progress, make necessary adjustments, and adapt to changes in the life and financial goals. So we can take the help from the financial advisor also. Like for example, if you are not thorough with the concept of finance planning and implementing, so we can take the help from the financial advisor also. So usually these financial advisors, they will assess clients' goals, like what exactly they want to plan it for, and the risk tolerance. It means whether they can bear the risk or no. Here the risk means it is completely related to loss, and lifestyle to provide personalized financial plans. They also guide clients on investment and savings options, help secure the best financial products, and update portfolios as needed. So here, we just saw that there are mainly six steps in the process of personal financial planning. The first thing here is I just explained about the current financial position. It depends on what is our income, what is our savings, how much property we have, and how much investment we have. Depending on that, we are going to make the future plans. The second, in this, again, I'll repeat, it is completely related to the goals. It may be short term, intermediate, or long term. Whenever we are setting the goal, it is completely related to smart financial goals. Here, the word smart, it includes specific. Whenever we are going to plan for finance, it should be specific. Whether we are going to do it for short term, or it is an intermediate term, or it is for long term. So short term, within a short period of time, it may include 1 year, and long term, it is completely above 5 years. Intermediate, it may be between 1 to 5 years. So depending on the priority, we need to even control the wants and needs also. But sometimes you may be knowing needs cannot be avoidable, but wants we can, we can postpone at least for a time being. The third thing here we discussed about reallocating existing resources. If you already invested money somewhere, or already if you have savings, that again we can plan for reinvesting for getting the better returns. Or else we can plan for generating new resources, like for example, working extra hours, earning more money, earning higher investment returns, where we can get better investment and increasing the income. And after having all this plan, the next step is to evaluate the alternatives depending on the economic conditions, personal values, life situations. So last thing, if you are not convinced with the process or the plan what we have done, we can even take the advice from the financial advisors, where they will have a thorough knowledge about the financial planning, and they will be helping you out to have the clear, practical, and actionable steps to stay on track. So review and revise the financial plan. So only there is a saying from Robert T. Kiyosaki. He says that the rich focus on their asset columns, while everyone else focuses on their income statements. So in the next, I am going to explain about what do you mean by financial statement and how it will be helpful. Being an individual, even we can plan our day-to-day expenses, and we can control our day-to-day expenses. So personal financial statements help individuals monitor their financial position, wealth, and progress towards financial goals. They are also useful when applying for credit or loans, as they provide lenders with a clear picture of an individual's assets and liabilities. For example, if I am making a financial statement for my personal purpose or individual purpose, then if I need any loan or a credit, I can use the same financial statement to show it. So here it is related to personal financial statements, objectives. Personal financial statements help individuals, obviously, and the purpose of doing this personal financial statement is to track income, expenses, and overall financial wealth. And we can also assess their current financial position. We can monitor progress towards the financial goals, maintain records of financial activities, provide information for tax filing and credit or loan applications. So it is, I feel this is necessary to maintain the personal financial statement. Just by seeing these objectives, it will be helpful to maintain. Next, here, types of financial statements or personal financial statements. There are mainly two main types of personal financial statements. The first one is income statement, and another one is a balance sheet. So, income statement shows an individual's income and expenses over a specific period. It helps to determine whether a person has made a profit. So, here, profit means which is a surplus, or loss, which is deficit. So, balance sheet shows an individual's assets, liabilities, and net worth at a specific point in time. So we can use the equation of income statement. So how do we identify that how much we have? The net income means total income, which we call it as a revenue, and uh, expenses. So net income equals to total income minus total expenses. This is the basic equation which we use to identify the net income. So here I can show you the format of personal income statement where we can compare the current year with the previous year, or it may be not just related to year, even we can compare it with the monthly expenses also. So we can see here income from occupation, salary, profit, commission or fees, then interest on savings, interest, dividends, income from investment, or it may be gifts, prize money, tax reimbursement, or any other income, which will come under the head of total income. And from these income, the total income, we are going to deduct the expenses. So expenses here, the contribution towards household expenses, which are unavoidable. Every day we make expenses for our household expenses, and emergency expenses, medical or any other, then insurance installment, one time expenses, flexible one time expenses. It may be related to travel, holiday, gifts, social occasions. So here to find the net income, we subtract the expenses from total income. Next, here you can see the personal balance sheet. It is divided into two columns: balance sheet and assets. Left hand side, the borrowings, home loan, personal loan, vehicle loan, business loan, credit card debt, other bills on credit, or any other expenses. We'll be showing it under the left side. And in asset side, total savings in all the savings, investment in real estate, land, gold, silver, investment in FDs, NSC, National Savings Certificate, recurring deposit, mutual fund, bonds, debts, shares, or any other types of investment we can show under asset side. Next, it may be related to retirement plan, pension fund, PF, PPF, other, or any other assets. We'll be showing it on the right hand side of the balance sheet. So here, after making all the process and these personal statement, next step you will have an investment opportunity. Now, by just making the statement, we got to know what is our income is and what is the present financial position is, so that we can make investment opportunity. So these are the strategies depending on our income, how much we are having at present. So an investment opportunity is the chance to invest in a tangible or intangible assets with the expectation that it will increase in value and generate returns in the future. So the first thing here we are going to discuss about the shares. What exactly the share is? Shares are small equal units of company's capital that represent ownership in the company. And people who buy shares are called shareholders. And shareholders can trade their shares in the stock market and may earn returns through dividends and capital appreciation, making shares a popular investment option. So these shares, they are divided into two types. The first one is equity shares, which are also called as ordinary shares. So here the characteristics of these equity shares are they represent the part ownership in a company. They offer higher return potential, but involve higher risk. And equity shares usually have the voting right. But compared to when we compare equity shares with the preference shares here they are also called as preferred shares. They receive dividends before equity shareholders, have priority in repayment if the company is liquidated. They generally do not have the voting right. So they get their priority in repayment only when the company is liquidated. So let us move on to the next one. Here we have bonds, debentures, and government securities. So bonds, debentures are fixed income investment through which investors lend money to governments or companies for a fixed period. The funds raised are used for business operations and infrastructure projects, and investors earn regular interest. So they are secured here. Why? Because they are all government securities where they can earn a regular interest. Second one here is government securities are also called as GSECs, are bonds issued by the central government, state government, or quasi government agencies. They are considered one of the safest investment options because they are backed by the government guarantee. The next step strategy to use for the investment is money market securities. Money market securities are short term investment instruments with a maturity period of less than 1 year. So we have a common types which includes T bills. It means treasury bills. They are the short term government securities with a maturity of up to 1 year. They are considered safe investment because they are backed by the government. Second one, here we have CPs, that is commercial papers. They are also short term, unsecured debt instruments issued by large companies and financial institutions. They have maturities ranging from 7 days to 1 year only and are used to meet short term financial needs. Next thing, CD. Here, certificate of deposit, which is also a short term deposit instrument offered by banks that provides higher interest, obviously, in return for keeping a fixed lump sum deposit for a specified period. So, it is also transferable and negotiable. Next thing, here we are going to discuss about the mutual funds, an investment option where many investors pool their money to invest in assets such as it may be stocks, bonds, money market instruments. The fund is managed by a professional fund manager according to its investment objectives. Let us move on to the next one. Here, this is related to investment in bank deposits. So, many people they use bank deposits. Actually, they are safe and they are very simple investment option where money is kept with the bank. Common types include current accounts, savings account, fixed deposit, and recurring deposits. They offer fixed returns and are considered safe investment due to RBI regulations. Next year, not only that, in banks, even we can invest in the postal schemes also. Postal schemes are considered as a reliable investment avenue because they are backed by Government of India. Post Office in India provides a wide range of investment schemes, which also include tax saving schemes. Some of them are discussed here. We are going to discuss. So, investment in postal schemes, NSC, National Savings Certificate. So it is safe and reliable investment backed by the government of India. And one popular scheme is the NSC, which is a fixed income investment available at post offices. It offers fixed interest, provides tax benefits up to 1.5 lakh under Section ETC, and is suitable for small and medium income investors. So, as I already told you, during the process, depending on the income, you have to make a strategy whether short term investment, intermediate, or long term, depending on the income. These are the investment avenues which are available. Next, in the post savings scheme itself, we have KVP, Kisan Vikas Patra, a government backed savings scheme that doubles the investment after a certain period, certain fixed period. And here the minimum investment is 1,000 with no maximum investment limit. Then POMIS, Post Office Monthly Income Scheme. It is a 5-year investment scheme. Next, we have Sikana Samruddhi Yojana, We call it as a SSI. This is specifically for girl children below 10 years. Next here, not only banks, post office, government securities, or any corporation, we even have the investment option in real assets. So, investment in real assets, in that we have real estate. So, investment in property to earn a rental income and benefit from capital appreciation rather than for personal use. And we have option like gold, a traditional investment that generally provides a steady value appreciation. It can be invested in through physical gold, gold ornaments, gold bonds, or gold ETFs. Then third option in the real estate is antiques, investment in historical objects such as coins, sculptures, or manuscripts. They may appreciate in value but involve high risk, including fake items and uncertain process. Next, financial versus physical investment. So, not just in securities, but even in the physical investment, let us see that financial investment versus physical investment. Financial investments or assets are intangible. They cannot be seen or felt and may not be having a physical presence except for the existence of a document and which represents the ownership interest held in the asset. Regardless of the fact that financial assets do not exist in the physical form, they are still recorded in the firm's balance sheet to represent the value that is held by them. For example, mutual fund, which is a financial investment, which is not physical in nature, but it is in the form of document. Same way, fixed deposits are there, certificate of deposits are there, bonds, stock, life insurance policies, and money market instruments, etc. But physical investments, as the name itself, which is physical in nature, we can see and touch. Physical investment assets are tangible assets and can be seen and touched with a very identifiable physical presence. We can see and make out, okay, this is a physical investment. These assets refer to the things that may be liquidated when the entity wound up its interest. Physical assets have a useful economic life. When it ascertains its age, it may be disposed of. Example, commercial buildings, real estate, agricultural lands, gold, silver, and other metals, commodities, antiques, and paintings, etc. So, a financial planner, we have a financial planner also. A financial planner is a professional who helps clients achieve their financial goals through effective financial planning. They encourage regular savings and provide guidance on investment planning, retirement planning, tax planning, risk management, and asset allocation. A successful financial planner possesses technical expertise, interpersonal skills, professionalism, and follow ethical and regulatory standards. So, here they are the professionals who will be helping the clients. Next one, setting the goal. Savings goal setting. Savings are essential for building wealth, ensuring financial security, and handling unexpected expenses. So, setting a clear financial goal helps in planning savings systematically for both short term, long term, and financial goals should be specific, realistic, and purpose oriented. Clearly stating how much to save and for what purpose. Saving instruments, this we have already discussed, mutual funds. Saving instruments help individuals achieve their financial goals and are offered by the governments, banks, financial institutions. And mutual funds are investment schemes where money from many investors are pooled and invested in shares, bonds, and other securities by professional fund managers. They are especially suitable for small and moderate investors because they provide professional management, portfolio diversification, and reduced investment risks, making it easier to achieve financial goals. Next thing here is we have types of mutual funds. Equity mutual fund, as we just discussed that equity, they are the primarily investment in stocks and hence go by the name of stock funds as well. Second is equity mutual fund can be actively managed or can be passively managed by the fund manager. In case of activity traded fund, the returns are predominantly dependent on the skills of fund manager only in generating returns. Passively managed funds are the index funds or ETFs, and they track the returns using the underlying index. And here, the debt mutual fund. Debt mutual funds invest is made primarily in the fixed income securities such as bonds, securities, and treasury bills. If an investor is looking for steady returns and less risky investment options, then the suitable option is debt mutual fund only. It is the investment made in securities which provide fixed interest on timely basis. These mutual funds also carry some specific types of risks. The risk will be, it may be the interest rate risk and credit risk. So the investor, before investing, he should study the scheme. Next, debt mutual fund invest in various fixed income instrument plans such as FMPs, there are fixed maturity plans, liquid funds, gilt funds, short term plans, long term bonds, and monthly income plans, and among others. Since the investment come with a fixed interest rate, the maturity date, it can be great option for passive investors looking for regular income with minimal risk. Then there is another option, money market fund, where it is a kind of mutual fund that invests in highly liquid short-term instruments. These instruments include cash, cash equivalent securities, and high credit ratings. Debt-based securities with a short-term maturity period. It is for this reason that money market mutual funds are considered safe or investment with minimal to low risk. Thank you. Thank you, sir. Thank you for giving me an opportunity. Any questions?
Thank you, Vani ma'am. This presentation on the topic personal financial planning. So, what are the personal financial planning? What is its importance? What are the government schemes? What should be the correct age to do the investment? So, everything you have explained very perfectly under personal financial planning and investment strategy. Here we have to do investment. So these things are useful for us because to have increase in our income, we do such personal financial planning so that we get more returns for our investments. And I request all the participants, those who want to discuss with our speaker, they can unmute. Thank you. Feedback link is available in the chat box. Kindly fill the feedback link to receive your certificates.
Thank you, sir. Thank you for giving me.
Yes,
Good
Dr.
evening.
Swanand Shukla, sir, please.
Good evening, madam. Thank you very much for wonderful explanations. And definitely the account matters a lot. The credit and debit, is a very important thing for us. And how we do finance, means investment, financial investment. That is one of the very important aspect. The question is, we are having nowadays for the trading, we are having some apps we are available, as well as, if suppose I want to make an investment, now there is no, personal financial some consultant required, but if I can also take a help of that. So what will be the difference between, if suppose I'm having a consultant with me and the app is there with me? So what is the what you feel, which one is more reliable? Because nowadays we are hearing stories that, the consultant also, lock their office sometime. So what do you think about this?
Sir, I prefer personal consultation only because they will be dealing with them as well as they will have more knowledge and experience in advising the customers.
So while doing investment, that what we say disclaimer is very important for us. Everybody should pay attention, more attention to those parts rather than what are the gains you are going to get. So the higher the risk, the higher the benefits. This is a formula what we are having. But many of the time, you'll find the people are losing their money in trading and various aspects. So one has to be very clear. So it may be a governmental or maybe postal, that investment is wonderful because they are more stable, what I feel. Maybe the returns will be little less,
Yes,
but
yes.
it will be safe. What you feel about this private sector and the governmental sector? So is there any difference between these two?
Government sector, sir. Yes, sir, government sector only.
Yes, thank you. Thank you very much, ma'am. Thank you for your wonderful explanation about this, and definitely it will be helpful in our future. Thank you.
Thank you so much, sir. Thank you, BETKAR sir, for giving me an opportunity to speak on my topic. And thank you, one and all present here.
Thank you, ma'am. Thank you, Dr. Sir, for discussing with our speaker. I am thankful to you, thankful to all participants, those who are joined here. I think they will take benefit of this financial planning for themselves. Thank you, sir. Thank you. Participants are requested to fill the feedback link, which is available in the chat box. Yes, you can give, ma'am. No problem.
Yes, sir. Thank you, sir.